view. Information so you can anticipate in advance what the market's going to do, so you know what stocks to buy, you know what stocks to short. It's all about having good information and anticipation. You got to anticipate. The one thing you can't do is rely on your brokers. Listen.
Our responsibility begins and ends with our partners and our shareholders, and that's it.
What are you, nuts? Partners or shareholders? You're not included.
Check out the free 10-day trial and follow Phil to investing success. Learn more at philsgang.com. philsgang.com. Now, here's Phil.
I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want.
Well, if that's the case, then why didn't you make the right monetary decisions early on? I mean, it's amazing. And even today, we're hearing again how strong the economy's doing. But there's a problem with that. There's evidence against that. And they don't want to discuss it. So today, we got a report the CPI went from 3.1 down to 2.7. They expected 3.1, but came in 2.7. And of course, the market rallied, the NASDAQ rallied. Here we go again. The tourists and the FOMOs running back the other way now. I mean, it's unbelievable. It was Tuesday. I think I got this right. It was Tuesday. The tourists and the FOMOs started to go chase the tech stocks. Wednesday, they lost money. Today, they go back in and chase the tech stocks. That's called volatility. I mean, you just don't do that. But let's get to the point. They're saying how the economy is doing much better, okay? That's what they're telling us. But before we get to that, let's talk about the tech stocks everybody's going back to buy, the AI stocks. The reason why the AI stocks that rallied on, I think it was Monday or Tuesday, I get confused with the day. I think it was Tuesday, right? Tuesday, yeah. And Wednesday, they came back down. Okay, the ones that rallied on Tuesday, the reason they gave back those gains the next day is because the institutional money is what you got to rely on. It's the institutional money, of course, that gives you sustainability when markets rally or they go down and you're shorting them. So, because the institutional money, they call the smart money, they have real deep concerns over AI companies, like Oracle, for example. They're spending tens or hundreds of billions of dollars on data centers, but they're not getting returns. Oracle needs to raise $38 billion more debt just to build a data center. The increase in AI debt just in the last 12 months went from $15 billion to $125 billion. The concern is it could reach $2 trillion. 54% to almost 55% of the smart money, institutional money, has been selling their tech stocks, their AI stocks, since January. And because they believe AI stocks are a big bubble. The valuations are stretched. Example, I always pronounce it wrong, Palantir, Palantir, P-A-L-T-R, the symbol, is trading 700 times forward earnings. What are you, nuts? NVIDIA, AMD, at PE ratios of 50? You got to be nuts. Another reason institutional money is rotating away from AI is because, again, the rally that you see where the institutions are standing on the sideline, the reason that the FOMOs and the tourists can buy when they have no money is because the same thing's going on now that happened right before the dot-com crash. Wall Street made sure that there was enough money in their margin debt accounts to attract those buyers of stocks who don't know what they're doing, they always make decisions on emotion, and they make the decision on fear of missing out, FOMOs. They have put in a record $1.8 trillion into these margin debt accounts. We have never seen such a debt surge. We just saw it go up $246 billion. Just lately, it increased $246 billion to get that $1.8 trillion. That's the faster than a speeding bullet. Fastest increase on record. But yet, the professionals and the institutional money, you need them buying to sustain these rallies or you lose them. But they're not going to buy because the valuations are stretched, the prices are too high. Now, let's talk about, we're being told the economy's doing well this morning. We're told the CPI, the inflation thought was going to come at 3.1, came at 2.7. They're telling us jobs are terrific and wages are going up and people have bigger jobs and more money than they ever had. Well, that's not the case. If that was the case, if the economy is doing so good, and I think we have somebody saying this, Willie. We racked up a cut if we have it. If the economy is doing so good and inflation is down like they're telling us, then why in the hell is Powell having to purchase $40 billion in treasuries each month from the banks and broker-dealers to prop up bank reserves? If the economy is doing so well, with inflation dropping and both wages and jobs increasing, he wouldn't have to do that. Deposits would be improving. You would see an increase in bank deposits, and then you see the reserves increasing. That's what we would be seeing. If they're telling us wages are good and the inflation's down, that would be seen in your deposits. But that's not what's happening. Deposits are getting worse. And that is why they can't hit their mandates. That's why the mandate of $3 trillion dropped below at $2.5 trillion, because we're not seeing that. It's always, if you have good jobs and you have a good economy, your bank deposits go up. If you and your household are doing well, don't your bank deposits go up? I mean, if you, at the end of the month, sat down with your spouse and your bank deposits are going down, and you say, hey, I just did the books, hon, we're doing terrific. Let's get the kids and go to Disneyland. Instead, again, Powell is propping up the bank reserves. You don't do that when you're doing well by purchasing $40 billion in T-bills from banks and from, of course, broker-dealers. I think we have a cut there. It talks about, what is it, Willie? Do we have that?
We look at the consumer spending. We talked about it, money in accounts, credit quality good, equity in our home strong, a lot of good fundamental things. That's going to come down to labor and wage growth. If you look at small businesses, they're doing a pretty good job of earning money.
Small business bankruptcies are up 47%. What the hell is he talking about? What is he talking about? But to really judge it, you got to ask yourself, here we are, 40 billion. Why in the hell does Powell have to go and purchase 40 billion in treasuries every month? Every month. It just makes no sense that he has to prop up the bank reserves by purchasing T-bills from banks and broker-dealers to get cash, prop up those reserves. Does that make any sense? No. And why would the government be increasing its selling of T-bills? Now get this. The government itself is increasing the sale of T-bills to the money market funds. Every month, they are increasing the amount of T-bills they're selling to the money market funds to raise cash to keep up with the 16 trillion per day of daily expenses that they can't keep up with. So if the economy was doing so good and deposits are going up and wages are going up, everything's wonderful, then why is the government, just to keep up with the 16 trillion per day in daily expense, we can't keep up with them. We don't have the money. And we don't have the money, what do? Thank God for money market funds. They'll go and the Treasury Department will give to the money market T-bills. They just print them up, give them to them, and we get the cash. And the other thing, banks. Why would banks, to cover their daily expenses, again, they wouldn't be selling CDs to the money market funds. So we got the government selling T-bills to the money market funds to raise cash. Banks are selling their CDs to the money market funds to raise cash. Corporations, they're in deep trouble. To cover their daily expenses, are selling their commercial paper. Selling their paper to raise cash. They're in trouble. So what is this? Everything's just ducky. It makes no sense. So,
what about the fact that the Fed is actually buying $40 billion worth of Treasury bills? In fact, that's beginning immediately later on this week. That is a form of quantitative easing, no? So would that further push up and further steepen the yield curve, in your opinion?
Yes, exactly. Because when you begin to buy the front end of the yield curve, the idea is indeed exactly to get short-term interest rates, to at least have them anchored around the effective Fed funds rate. So that also means that therefore the yield curve is at risk of turning steeper.
So that's a good point. That's a great point. Now, what Powell is saying, oh, I'm not doing QE. Oh, there's no QE here to see. Nope. Look at it's QE regardless if you're selling T-bills or you're selling 10-year treasuries. The effects, I talked about this yesterday, are exactly the same. Exactly the same. You're trying to push down yields, the interest rate on both. That's the objective. Get those interest rates down so they can do stock buybacks. Now, thank God, what would the government, what would the banks, what would corporations do without access to money market funds?
2 minutes.
Think about it. You know, when you purchase a money market fund and you get 3.6% interest, or let's say you open up a brokerage account, new brokerage account, and you give them 10 grand, the brokerage people will take that 10 grand, they don't leave it in there, they go buy money market funds. I mean, everything goes back to money market funds. So money market funds is the pillar, the foundation of our money system. Thank God we got money market funds. Otherwise, our banks, our corporations, and of course our government, which is insolvent, would be technically solvent. The money market funds, every time you buy a money market fund, you're doing something greater than just saying, well, I'm going to get some interest. I got a little money here, I'm going to put it in money market funds. Do you understand? You're doing something bigger than just putting money in there and get interest. You are holding up. You are part of the game, okay, to keep our government, our banks, our corporations solvent. If it wasn't for the trillions of dollars, I think there's somewhere around 7 trillion, 8 trillion in money market funds. And that is what makes money market funds such a pillar. We'll talk more about this when we get back.
Want more information on this show? Go to philsgang.com or give them a call at 877-600-GANG.
At St. Jude Children's Research Hospital, we're fighting against childhood cancer every day. At the heart of this battle are our donors.
Most of us want to make some type of difference in the lives of others. St. Jude does miraculous work.
The fact that no one has to pay, it's a place where everyone is treated as an equal.
Everybody is welcome here, and it doesn't matter your religion or what part of the world you're from, all that is taken away. It just gives you some hope.
It's just a nice feeling to put your energy into something that really does genuinely make a difference in a child's life.
There's just no greater gift. If we have the ability to help, then we have a responsibility to help.
Finding cures, saving children. St. Jude Children's Research Hospital. Find out how you can help at stjude.org.
You want to invest your money and grow your wealth. How do you invest intelligently? Become a Phil's Gang member and receive the training, advice, and software that will take your investing to the next level. Our team is comprised of successful investors, all with proven track records. Phil's Gang software is easy to use, painless to navigate, and tells you exactly when to buy and sell to help maximize profits. Learn about common market mistakes and how to minimize them. Phil's Gang has successfully taught tens of thousands of investors how to navigate the market with confidence. You don't need to be a seasoned investor to benefit from the Phil's Gang platform, no matter what level of investor you are. Phil's Gang strategies for investing are designed to put you on the path to success. Sign up for a 10-day free trial to see our platform in action, avoid market pitfalls, and start winning with Phil's Gang. Learn more at philsgang.com. That's philsgang.com. Welcome back. Are you ready to make profits in the stock market? Why not check out philsgang.com or give us a call, 877-600-4264. Now, here's Phil.
And welcome back. So, when we hear how everything is doing great, the evidence is not there, but we don't care. I mean, in the sense of, look, we know the biggest problem we have right now for our government, they won't cut. They just won't cut expenses. They won't cut deficits. So we are, every day, we have to meet 16 trillion per day daily expenses, and we don't have the deposits. The deposits aren't good. And that's the funny thing. When they're telling us how everything's really good, then it would show up in our deposits. Our deposits would improve, and then that means if our deposits are improving, the funds would go up. So, but we're not seeing the reserves would go up. But they're not doing that. They're doing terrible. So they're pushing up the reserves again by Powell's going out there, right? And he's purchasing, T-bills and everything else. So think about what we have every day. We can't pay every day our Social Security. The biggest daily expense is Social Security, Medicare, Medicaid, SNAP. That's all the food. It used to be known as food stamps. Now it's called SNAP. And all the benefits we pay to all those lazy people that work at the federal government, that sit around all day doing nothing. Been there for years with big fat pensions. We can't cover those. All the benefits. And look at the programs that we support, all the different kind of income programs we're supporting. And they're telling us, oh, things are good. I mean, we got to cover those daily expenses. So we got to sell to the money market funds CDs, banknotes. I mean, banks, just talk about the banks to cover their daily expenses, what they got to do. They got to sell to the money market funds to survive. If the money market fund wasn't there, these banks would. Remember, the banks aren't solvent. The only way they stay solvent is to cover their expenses, their daily expenses. They'll keep selling to the money market funds their CDs. Here, take my CDs. Take my short-term banknotes. Corporations, oh, they're really strong, they're telling us. Things are good now. Well, they can't cover their daily expenses either, just like the government can't. So the government can't cover their daily expenses because their income is not good, their deposits aren't good. So the government's deposits stink. That's all you got to look at. And when deposits stink, your reserves go down. And when your reserves go down, and it goes down below your mandate, as I tell you over and over, they can take that $600 billion that right now is a loss, but they just don't classify it right now as a loss. But they will at some point if we don't keep those reserves up. But we dropped down to 2.5. We're supposed to be at 3. But he pushed those reserves back up to 3 the other day because he's selling these T-bills, and especially he's out there every day selling these damn things. So, anyways, as I said, the next time that you purchase a money market fund to get your 3.6%, you're doing much more than that. You're making sure the banks, the corporations, and our government is not failing. That's why inflation doesn't come down. Inflation doesn't come down. And this thing about QE, they're starting to argue about. Let's see, I think there's another, which one? Play the other clips I had here that we racked up. Go ahead. I think it was...
What about the fact that the Fed is actually buying $40 billion worth of Treasury bills? In fact, that's beginning immediately later on this week. That is a form of quantitative easing, So would that further push up and further steepen the yield curve, in your opinion?
Yes, exactly. Because when you begin to buy the front end of the yield curve, the idea is indeed exactly to get short-term interest rates, to at least have them anchored around the effective Fed funds rate. So that also means that therefore the yield curve is at risk of turning steeper.
Turning steeper. So QE is not our friend. It's not our friend. So what we got to be doing right now, the market is confused. The market is volatile right now. So what we've been doing, and of course, if you want to follow us, just join our gang. And every day we follow the money market funds. Every day we follow the money market funds. That's the thing, one of the biggest things you follow, okay? Because, again, that really tells you what the economy's doing. I mean, if corporations are in there, and banks, and especially the government's in there, and Treasury's in there every day, giving them a short-term T-bill to get cash. I mean, think about that. They just have to walk over next door, give them just a piece of paper, says T-bill on it. Hey, I need $23 billion, whatever. The machine's in the back, prints it, comes out in the front. Oh, here's your money. Now go over there and pay your Medicare, Medicaid, Social Security that we can't pay. I mean, it's just amazing how government works. We will never get rid of our inflation until someone in government, finally, some president, somebody says, we got to stop this craziness because for our children, but especially the grandchildren, what they're going to be facing is going to be a monster. Nobody ever wants to get rid of the inflation. Nobody ever wants to stop spending. All Congress knows is the more they spend, the bigger the government, the more money they can bring home, and the more bridges they can build to nowhere, the more dams they can build where there's no water. They can stretch the airport runways from 1 mile to 5 mile, even though at 1 mile there's only 13 people that go through their airport a day. So it's 1 mile, that should take care of them, but they go to 15 miles with the same 13 people. It's all about bringing the bacon home. So let's go to the stocks, okay? So let's take a look at what's going on. Discretionary. The other day, not everybody, because the institutions are out of the big AI stocks, they're out of the semis, they're out of the tech stocks, they're not in those. The people who are left in the tech stocks, okay, again, are the FOMOs who buy at the peak, and you got the tourist investors. So they jumped in and they bought, and I'm going to put them up here for you. They started to buy all the top tech stocks, right? And they went up. So if you take a look at, for example, they got out of the bank stocks, they got out of Citi, for example, okay? And they got out of, which was crazy, they got out of, let's see, Citi. What was the other one they got out of? I think it was it JP Morgan? I think it was JP Morgan. But they got out of the banks and they went back and they started to buy, again, Meta. So they got into Meta, thinking they're going to get rich because they think, oh, it's on the bottom. That's good. The stock dropped from, let's say, $800 down to $60. That's good. That's a deal. What they don't understand is between $664 and $800, you got tremendous amount of sellers. You got to break through those sellers. How do you get through those sellers? You need increased volume. You need big volume. We don't have the volume because the institutions aren't participating in those stocks. So every time you buy a stock and you get 1, 2, 3 up days, it always will come back. So if you bought at 664, and let's say just pretend it went to 700, well, it's done. It's done. We can tell from our volume it's done because the people who sold it short from, let's say, from 769 down to 580, and let's say they made $5,000, they haven't made that $5,000 yet. So if I borrowed Meta from you at, let's say, at 800, and I believe it's going to go down to 500, I borrow it from you. You laugh at me saying, oh, that's stupid, Phil. It's going to go up. But all right, I'll sell it to you. I'll lend it to you. You just borrow it. So I borrowed it at 800, and she dropped down to 500. We use it as an easy number. Well, he lost a lot of money, didn't he? Because think of it as an option. I have an option to buy that back. I don't mean option in trading. I'm just talking about verbiage here. So it went from 800 to 500. I made $5,000, we'll say. Well, I haven't made money until I buy it back. So the minute I start buying it, it goes from 500 to 580. Then it goes to 600. Then another guy who did the same thing as me, he says, oh my God, I'm losing money here, starting to go up. I better jump in and I better buy mine back. And I better buy mine back. And I better buy mine back. So all of a sudden you got all these people buying their own stock back because they don't want to lose their profits. So the stock will generally run, okay, about 25, from the peak to the low. Off that low, it'll probably go up about 25% of the way. Then it will stop. Because above you got all sellers, and you don't have new money coming in yet. And what are we missing with new money? Who do you want coming in? Institutions. That's why the day that people jumped in the other day to buy the tech stocks to rotate out of discretionary stocks didn't understand that. That's why they're losing money. Now, if you go and let's take NVIDIA. Now, NVIDIA, we shorted NVIDIA. We had a beautiful short on NVIDIA. We shorted from $200 down to, I think it was the low of about 173. But anyways, so at $200, that's about a 10% gain. I said, can I borrow your stock at 200? Because I think it's going down. And he laughs at me. He said, oh, we're never going to have a crash. You always said there's going to be a crash. There'll never be crashes. So I borrowed it at 200. Now it went down to, let's say, just quick math here, let's say 170, 200, 170. I did really good, but I haven't made any money yet. On paper, I did. But now what I'm going to have to do, I'm going to have to actually buy that stock now. So the guy I borrowed it from, let's say at 200, he really lost his butt. But when I start buying mine, I'm the same guy who sold it short, buying my own stock back. It's going up. Now the next guy who did what I did, he said, gee, I better go buy mine back now before I lose some of my profit. So he jumps in, buys his stock back. It goes up. The next guy jumps in. Oh, my God, I better now buy my stock back before I lose all, before all of a sudden the stock is going from, the drop from, let's say, 200 down to 150. I lose it all. So as it's going up, because you don't have institution players in these stocks, it's going to go very quickly. Because the people who sold short are buying their own shares back, it goes up quickly. And when it goes up quickly, the FOMOs, fear of missing out, and the tourists all jump, give me in, give me in, give me in. And all of a sudden it goes up, it stops. So let's say the stock went from, let's use an easy number, 170, and it stops at 190. What happened? How come it stopped? Should it keep going up? No. Because the same people who bought it at 170, when they bought their stock back, it went up from 170 to 180, we'll say. Now, to get from 180 to up to 212, the peak, those are all sellers that are still in there. So how are you going to do that? You need institutional money. So you get my point. All these tech stocks get these first little booms, these first little pops, because people don't understand. It's the same people who said they're going to go down, who short them. They're the same buyer. And it goes up about, let's say, a third of the way, and these people are jumping and buying. Hurry up, get me in here, get me in. So again, you got to learn how to sell short. You really do. We'll help you with that. But again, thank God for money market funds. If we didn't have those, we'd be in deep trouble. They're masking all the games going on. Join my gang. See you on the charts. PhilGang.com.
You have been listening to Phil's Gang with your host, Phil Grande, on the Off the Wall Street Radio Network. Off the Wall Street Radio Network. Remember to visit Phil's website at philsgang.com. That's philsgang.com. Or call the office, 877-600-4264. That's 877-600-4264.
It's up to me.